Thanks, Tom. This is the fourth quarter 2011 bond funds review, and I'll kick things off with some major themes for the quarter. Well, I would do that. Let's go with the yield curve changes. We saw in the fourth quarter that the what was going on in the bond markets was fairly flat. We didn't see a whole lot of movement in the yield curve over any of the common durations that people use. For instance, the 30-year, the most volatile one, did peak near the end of October and then came back down and ended the quarter roughly where it started. This was the same theme for the 10-year, the 2-year. Once we get down a little bit lower, I'm sorry, that was the 5-year, then at the 2-year and everything lower, there just wasn't a whole lot of movement at all. So when we look at the change in the overall yield curve over the quarter, we can see that the two lines at the bottom, and they're hard to distinguish, but the red line is at the end of the year. There's a light orange line underneath it. That was the end of September or end of third quarter yield curve. They were virtually the same. Of course, there was some slight movement, as we saw by the end of October. Things had started to settle back down, and at the end of the quarter then we didn't have much of a difference overall. The difference in the quarter for performance was a matter of degree here. We certainly saw a change in what was going on with a number of investment themes. For instance, TIPS funds, Treasury inflation protected securities, were one of the leading government and Treasury groups for the quarter. They were up about 2.2%, which belied their success over the year, where they were up over 11%. And this is despite very few, if any, indications of inflation. The next group down, short investment grade funds, were relatively moderate. For the quarter, we saw intermediate investment grade debt funds, which is the most popular investment for fixed income investors. Those funds were up about 1.33% for the quarter and about 6.2% for the year. Again, it's a good annual figure, but it pales in comparison to what was going on in the rest of the fixed income universe, where we saw double-digit figures in some areas, notably in the long-term treasuries, which we'll cover in a few minutes. For the quarter, the best performance, though, was reserved for high-yield funds. There was another risk-on trade in the market. We saw high-yield funds accelerate to about 5.6% on the quarter. Unfortunately for them, this was kind of a late showing, and for the year, they were only up about 2.8%. So all of their yearly performance came in the fourth quarter, where they made up some lost ground. Below them, loan participation funds, kind of riding the coattails of that risk-on sentiment, gained about 3.2% for the quarter, only 1.2% for the year. Again, they had a setback early on, and it just took some time to claw back some respect by investors. A little farther down, let's look at general U.S. Treasury funds, third from the bottom in this group. Their 1.25% return for the quarter seems a little muted relative to everybody else. Again, on an annual basis, though, in 2011, a spectacular year, they were up about 15.8%. Yeah, check that, 15.8%. This was the same sector that a number of well-known bond managers had avoided early on, much to their chagrin. We saw some other areas, such as world income funds, do pretty well. Emerging market debt funds gained 2.9% on the quarter, only 1.6% on the year. International income funds, if we look down, they slipped a bit on the quarter. For the year, they were up just under 3%. Again, a lot of strong dollar movement there, kind of muted their returns. Now, the look ahead. We've got a couple of themes here. It's all about Europe right now. The ECB is likely to cut rates. They had some funding problems, and on the periphery, of course, it's well known what's going on in Greece. The risk for the Europe recession remain fairly strong. They're not out of the woods by any means. We expect the euro to be weak. In fact, it's not unlikely that they could touch the August 2010 low of $1.2584 to the euro. That's kind of a recent low for them, and they're getting towards that number right now. So I could see the dollar strengthening, and this probably will weigh on international income funds, and of course, to Tom's point, that's going to affect international income funds as well, who were laggards already. The next area, the end of the TWIST program, Operation TWIST, is set to expire in June of 2012. This has been very supportive of long-term rates, and that will expire in a couple of months. For now, though, we've seen what it's done to the yield curve. It kind of flattened out slightly, very, very slightly over the quarter. It was relatively unchanged. I think that's probably a better descriptor of what I foresee in the first quarter of this year. Not a whole lot of movement on the yield curve. I know there's some forecasts out there of rising long-term rates at some point, but when we look at what's going on in the global economy, I foresee some moderating global growth. Worldwide output is forecast to grow only 3.6% in 2012. That's about 1.5 percentage points lower than it was in 2010, which was a period of recovery. Now, that's not to say that 2011 growth it was flat, but we do expect that the worldwide forecast is about 3.6% overall. That's probably a fair number in my mind, due to a lot of the fiscal belt tightening going on around the world, not only in the U.S., but Europe certainly is the best example of that. The Eurozone, as I pointed out earlier, has some real downside risk. A recession in Europe is a decent possibility at this point, again, due to all the underlying factors going on. Growth in the U.S. and Canada is likely to stay at under 2% this year. Tom pointed out that Brazil and India are slowing as well. So, yeah, there's a lot of factors at play here to sort of moderate that global growth and kind of keep a lid on increasing interest rates. And to that low rate point, we can look at some of the government benchmarks out there. Japan's 10-year note is yielding about 1% right now. For the U.S., U.K., Germany, that same benchmark note is about a 2% yield. In France, it's about 3%. And we can look at a few other economies and see where these numbers kind of go crazy if you're looking at, say, Italy or especially Greece, and but those aren't the major economies of the world. But the leading ones are very low right now. That's kind of hard to change. So we also see this as a positive environment for bonds. Accommodative monetary policies around the world and more fiscal discipline tend to keep a damper on any sort of rising rate pressures. China and Brazil are easing credit right now and trying to expand the money supply, so that's one headwind to consider. In fact, China did raise about $101 billion in new loans in December. This was their highest level since April of 2011. So there's a lot of accommodative policy out there. There's a lot of credit expansion trying to start in some areas, but I don't think it's a global phenomenon right now. Brazil also raised about $825 million in a reopened 2010 note. That's at the lowest yield ever for that maturity in Brazil. So people are looking very positively once again on emerging market debt. That's probably a good sign for kicking off the year. But inflation pressure remains low generally in most markets. It seems likely to stay low. There's a lot of excess capacity in several sectors. So overall, I feel very rather bullish about the environment for bonds. As Tom pointed out earlier, there's a lot of there's kind of a move to a risk-on theme in the market. Again, that jump in equities in October kind of indicated that sentiment is changing. For the year, the 10-year Treasury was up over 29%. That was their best year since 1995. So that longer duration, the more risk-on, is something that's not only indicative or found only in equities, but also in the bond market as well. Lower credit strategies as well. This is kind of a late change in 2011, but we've also seen very volatile spreads over this period. So while we could see a continuation of Q4 themes, a return to risk in the fixed income side, it's going to be a very volatile ride as well. So it's hard to bet on anything like that. The only ones that seem logical at this point is not making an interest rate bet. Again, govies and sovereigns have been very strong. The dollar remains a very strong level as well. The U.S. dollar index dropped in October and then rebounded near the end of the year to where it was at the beginning of 2011. So I continue to see some dollar strength out there. If there's one sector that I think holds some momentum right now besides the high yield area, it would be munis. Investors, and Matt will go into more detail on the flows, but the flows into munis were kind of up and down this year, but issuance was also at a 10-year low in 11, just $287 billion. So there's whatever demand they have is going to be met with a light supply, and of course that tends to bode well for most fixed income sectors when you see that kind of discrepancy out there. So overall, I'm still very bullish on bond funds for 2012. I think munis will outperform. I think high yields are going to have a volatile ride. Treasuries are likely to see a little backup here and there. They've lost some of their luster, but again, I think we've lost a lot of the flight to safety performance that we saw in the first half of 2011. That doesn't seem quite so necessary now, but a real hiccup in Europe could bring those numbers back to the fore, and we could see a change in position as far as the difference between the most conservative, the general treasury, and the more risky high yield and bank loan fund strategies. So overall, I think it's a good year in store for us, and I think it was obviously the numbers point out a superlative year for fixed income funds of most flavors in 2011. And with that, I'd like to turn the presentation over to Matt.